Hello, Marc Ostwald from ADM Investor Services International, with some thoughts on the volatility that we saw last week um, above all in US markets, and some observations about what they tell us, even though things appear to have calmed down a bit in the meantime. So I'm going to start off with a chart which is the US 10-year yield, and just highlighting on the chart that when we got to Thursday evening and we bounced the US 10-year yield in a very volatile move through the S&P dividend yield, which at the time stood at 151 and is currently 149. So there was a little bit of a turnaround in the market. It generally is always a fairly reliable signal that if you have the US Treasury yield going above the dividend yield of the S&P 500, then it's time basically to reverse back perhaps a little into US Treasuries. So that was certainly a trigger. I think a lot of the move was actually did have to do with month-end and month-end rebalancing. So how did it sort of play out? Well, the second chart is comparing the VIX volatility index with the MOVE US Treasury Volatility Index. And I think the important part here really is to note that the VIX basically didn't really do much at all. It had a little bit of a spike, but nothing like the sort of spike that we saw in the MOVE Treasury Volatility Index. And above all, when one compares how the MOVE Index preceded the big spike that we saw in the VIX Volatility Index back in February, March of last year, certainly nothing of the kind. It would seem to suggest that equity markets are fairly immune to all these higher moves in treasury yields, but we'll see about that. My third chart is another one to highlight just how insensitive credit spreads have been. This is a familiar chart. It's the US high grade, that's the white line, versus the US high yield average credit spreads. As one can see, we're almost at the lows. We've had a little bit of widening out, but it's hardly significant. I think the interesting aspect here is, one, we've seen a huge amount of volume of issuance already in the first 2 working days of March. Investment grade, 48 billion. High yield around about 5.1 billion. That takes the investment grade year to date issuance volume to 305.5 billion. That is a fair stretch ahead of what we saw last year, 235. Perhaps this is indicative of the fact that corporates are basically trying to front load some of their issuance for fear that we'll actually see a more permanent rise in US Treasury yields, but we shall see. That issuance level bears out in my fourth chart, which is the US dollar 5 and 10-year swap spreads. This is the spread of the swap rate over the equivalent US Treasury maturity. As one can see, there's been a widening of spreads. It's really basically come under pressure mostly from that issuance, but really in the greater scheme of things, it's hardly dramatic. But if we're going to carry on with the current volume, this is something we're going to have to keep a close of issuance, then this is something we're going to have to keep a very close eye on. 2 things I think to end with that will be of greater concern to the Fed and to policymakers. First of all, is a chart of the bid-ask spread. This is the bid-ask price spread in the US 5-year. As one can see, that spiked all the way up to the sort of levels that we saw during the extreme volatility that we saw last year. Now, this is basically telling me one thing, and that is all the amount of liquidity that the Fed may be pumping into the banking system does not give the market a lot of depth. And basically, secondly, the other issue is that the problems that we had last year with basically liquidity being in the wrong places and therefore leading to a very dysfunctional market is still very much a threat. The final chart for this week is the June Eurodollar 2023 chart. This basically should still be telling us, if we are believing the Fed, that they're going to keep rates at the current levels for a very protracted period. It should still really be up at the higher levels of the chart. As one can see, the markets have pushed very sharply back on the Fed's suggestions last week. And as much as we've recovered, they are still basically discounting the idea that the Fed will have to taper. So plenty of risks around for people to consider.